Well, glad you're back with Gold Seek Radio's second power hour of leading-edge financial news and interviews. My featured guest today, a top gold market expert, James Turk, founder and chairman of GoldMoney.com. James is co-author of The Coming Collapse of the Dollar and How to Profit from It, Make a Fortune by Investing in Gold and Other Hard Assets. Welcome back, James.
Hi, Chris.
Haven't you said that you have a place in Connecticut as well as England?
New Hampshire.
You know, I know both places are excellent choices, but the winters can be kind of brutal there. You know, with prices as low as they are on homes today, why not somewhere like the Sunshine State?
Yeah, well, this is a holiday home up in the mountains, and I guess I prefer mountains over beaches.
Right, and probably family in Great Britain.
Exactly.
I live in the mountains here as well of Appalachia, and the cold can be pretty brutal sometimes. So
yeah, not like up here in New Hampshire where they have two seasons, winter and August.
Well, let's start off with one of your latest articles. You note the remarkable disconnect between paper gold and physical. Would you say that gold backwardation, where the current gold spot price trades higher than the futures contract, is a sign that investors have lost faith in the exchange's ability to deliver the yellow metal in the future? And isn't it somewhat bullish?
It is bullish, and the point you describe is one element of it. In a broader sense, what it's really reflecting a lack of faith in paper currency and promises in general, because people would rather own physical metal instead of accepting someone's promises. Backwardation is an abnormal state for the precious metals markets. It doesn't normally happen because people who have physical metal would sell the spot and buy back into futures at a lower price and profit from the difference. The fact that it hasn't happened is an indication that something's amiss in the metals markets, and I think we saw a good example of it today. You had the price run down at the opening in COMEX, and then during the London fix, when the physical market trades, the price ran back up. As soon as the London fix was completed, the price was run right back down again. It just goes to show that the markets are a bit abnormal.
You know, you alerted subscribers to silver backwardation this February, and cited the nickel fiasco of August 2006 on the London Metal Exchange, where a force majeure allowed the shorts to default. Do you believe a similar event could occur in the silver market, or has this threat passed?
No, I don't think the backwardization threat has passed, and I do believe that something like this could happen in either silver or gold, as conditions continue to deteriorate here for the banks and for the economy. In this kind of environment, people would rather own real things instead of promises. And in that kind of environment, people opt for physical metal rather than just some kind of paper representation of it.
There are reports indicating that the Treasury has suspended its gold and silver eagle minting program once again, just as they did in 2008.
Yeah, I haven't followed it that closely. I have been reading news reports. I don't follow the coin market that closely. But again, it's an indication that there's just not enough physical metal at these low prices. The price of metal has to go up in order to encourage people, to entice people to sell some of the metal that they're holding. The strong hands who have metal now that don't want to part with it at current prices, but at a higher price they might, and that would bring the market back.
James, during the 2001-2008 precious metals bull rally, on a percentage basis, silver outperformed gold. Now, from trough to peak, silver ran from near $4 to north of $21 during that amazing bull run, approximately a 500% gain. However, during the credit crisis, deflationary fears have somewhat subdued silver relative to gold. While the yellow metal is still within earshot of its former high, silver remains far below its $21 high point. For our silver investors out there who are legion, what signs will indicate in your mind that global industrial demand for silver is returning?
I think it's more in terms of the monetary factors that are going to be important going forward from here. Silver is much more volatile than gold. I am more bullish on silver than gold in the long run, but you do have to accept this volatility when you own silver. To put it in economic terms, the demand for gold is inelastic. People want it at any price. The demand for silver, on the other hand, is elastic. It's very sensitive to changes in price. So you can see this volatility in terms of the gold-silver ratio, how many ounces of silver it takes to buy an ounce of gold. During precious metal bear markets, as we saw from 1980 up until the early 1990s, or mid-1990s. The gold-silver ratio went from 15 to over 100. It took over 100 ounces of silver to buy an ounce of gold from 15 ounces of silver in 1980. And since then, we've been going the other way, because as new money comes into the sector, because of this difference in demand characteristics between gold and silver, it has a bigger impact on silver than it does on gold. So the ratio has generally been falling. Now, what happened last year is we were down to something like 46, 47 on the ratio, and after the Lehman Brothers collapse and the deleveraging by hedge funds, investors and hedge funds sold what they could sell, not necessarily what they wanted to sell. So they sold a lot of silver, and the silver price got hit. But now silver's been bouncing back more rapidly. We went from 47 or so on the ratio up to 80s, the low 80s. We're now back to around the 67, 68, 69 area ounces of silver to buy an ounce of gold. That suggests to me that you're going to see strong price action upward for both metals. Plus, we had this period of backwardation in London as well, which was also very bullish for silver.
I'd like to discuss the seasonal patterns which gold and silver often display. Over the past few decades, precious metals bulls typically ran the market higher from early fall into late spring. Then by April or May, the bear was roused from hibernation. Traders could practically set their calendars by this regular event. But much of it was attributed to the Indian wedding festivals and related precious metals purchases in autumn and winter. If history is our guide, the seasonal factor will be working against the bulls in the next few months. And I know as a market historian, you understand that these market advances, they're like tides. They come in intervals. Do you subscribe to the thesis that a breakout above 1,000 in gold